Good afternoon, respected seniors and dear friends. After the clause-by-clause analysis of tax audit report, it's time to have the discussion on the common mistakes in preparation of tax audit report between the experts who have mastered the topic. The experts are CA Mukesh Khandwala sir, CA Jignesh Shah sir, and CA Palak Pavagadhi sir. The discussion will be moderated by CA Manthan Khokhani. It is indeed my privilege to introduce the esteemed panel members. First, I would like to introduce CA Mukesh Khandwala sir. He is a senior partner at CNK Khandwala and Associates. He has an extensive experience of over 40 years in the field of accountancy, auditing and taxation. He is a past president of CA Association Ahmedabad. He has held various positions at CA Association and ICAI Ahmedabad and contributed immensely to our esteemed profession. I would like Sunil sir to give a moment. Now I would like to introduce CA Jignesh Shah sir. He is a partner at JT Shah and Company. He has been into the practice for more than 30 years into the field of audit and taxation. He secured ranks for all 3 years of BCom and also at CA intermediate and CA final levels. He has served as secretary of CA Association Ahmedabad and also as member of various committees thereof. Please Sunil sir. Now I would like to introduce CA Palak Pavagadhi sir. He is the proprietor at Pavagadhi Shah and Associates. He is an expert of direct tax advisory and litigation as well as audit and assurance with an experience of almost 25 years. He has also an experience of 18 years in the field of teaching and many of us like me would have studied under him. He has been member of various committees of ICAI, CA Association Ahmedabad, AGFTC, etc. He regularly delivers lectures across various cities of Gujarat. Welcome, Palak sir. Last but not the least, CA Manthan Khokhani, an associate member of ICAI who endeavors to dedicate and excel himself in our profession, particularly in the area of domestic taxation. He has secured 8th rank in India and at CA final examination and 9th rank in the state in HSC examination. He has fine command over drafting income tax appeal and excellent grasp over interpreting direct tax laws and applying the principal accounting standards to help resolving the queries of clients. He is currently convener of Brain Trust Workshop Committee of the CA Association Ahmedabad and member of Students Committee of WIRC ICAI. He is also the deputy convener of Ashram Road CP Study Circle of ICAI. Please give him a round of applause. With this brief introduction, now I would hand over the chair to the esteemed panel and the moderator. Thank you.
Good evening, everyone. I know this has been a long day and all of you are waiting to just get out from here, but will not take much long. We'll try to wrap this up as fast as possible, but also at the same time try and cover all the possible questions or all the possible errors that we normally encounter in preparation and filing of the tax audit report. What surprises me actually is a topic that we are discussing was introduced way back. I'm sure when sir must have started his practice in 1980s, this tax audit would have been introduced. And even after 4 decades, we are still discussing the common errors in preparation and filing of the tax audit report. That is the beauty of this form, that it has been subject to so many of changes and there has been an increase in our responsibility as well, and therefore it is of paramount importance for us as chartered accountants to make sure that while we prepare these forms, we just not only prepare it, but we understand each and every clause and do the correct reporting as far as it is possible, since it is a certificate or what we are doing is certifying rather than giving an opinion. With these brief words, મને બસ આ ક્ષણે ભગવદ્ ગીતાનું 2 લાઈન યાદ આવે છે, જ્યારે કૃષ્ણ ભગવાન અર્જુનને કહે છે કે અર્જુન, આ બધા પ્રશ્નો તારા નથી, દુનિયામાં જેટલા છે બધાના આ જ પ્રશ્નો છે. એવી રીતે વોટ આર ક્વેશ્ચન્સ દેટ આઈ એમ ગોઈંગ ટુ ડિસ્કસ, આ બધા મારા ક્વેશ્ચન્સ નથી, કદાચ બધા તમારા લોકોના પણ આ જ ક્વેશ્ચન્સ હશે કે તમારા લોકોની બી આ જ ભૂલો થતી હશે. સો વોટ આઈ ટ્રાય ઓર વોટ આઈ હેવ એન્ડેવર્ડ is to identify all such small errors. Obviously બધી જ તો possible નથી, and we have a beautiful ICAI publication which just came a few days back which has tried to cover all the possible errors. The Tax Audit Quality Review Board has done a wonderful job, and I would recommend everyone to go through it. But what we have done is try and cover into 7 different paragraphs or 7 different clauses of the tax audit report, and we'll divide into the panel. And at the end, if time permits, we have a rapid fire round of questions, and then we can wrap this session up. Starting with the first set of questions, I would ask CA Mukesh Khandwala sir to take the charge. Let's start with the basics first, or what is the most ignored part is the connection between SS 700 and the 3CB report. Sir, can you highlight, because I'm sure in most of our tax audit reports, SS 700 is the most ignored aspect of it. So if you can highlight on the interconnection between SS 700 and 3CB report.
Good evening to all. See, right from as the moderator has lightly said that since 1984, this form has been introduced, 3CA, 3CB, with various amendments till today. Previously, as I understand that taxation and accounts were quite two different compartments, two different departments, and very less communication, integration between the two. But in view of the current scenario, the Institute of Chartered Accountants of India and Tax Department, they are trying to be aligned with each other, and almost all the guidance note or institute's publication is in line with what is the wish of, what is the requirement of department, income tax department particularly. So originally 3CBA, 3CB is a form, and when we learned this Income Tax Act and law, that we understood that you don't have any space to change the prescribed form. So meaning thereby form is prescribed and I cannot make any change in it. Even many of us today also we are having the same idea. But with the development of guidance note and auditing practice in all, and this safeguard of auditors and the stakeholders, the institute has come up with several guidelines and directions, including amendment in Company Act also. So with that, institute has come out with SS 700 revised. Friends, SS 700 revised is since long it was going on, but in last meeting of institute, that is on 3rd and 4th February 2022, the institute has come with revised SA 700 with a clear-cut intention that it is very much important for all the auditors to adhere to it. While when I am doing this my tax audit, I simply go on 3CA, 3CB, clause by clause. If any observation is there, then we write, otherwise nil, no, everything. And for continuously since last many years, this simply date, change date, and year change, nothing more has happened to bar. But institute has advised that it should be linked with SS 700 and how to do it. That is a $1 million question. In the guidance note itself, the institute has provided that's how to align with the SS 700 and 3CA, 3CB. That as there is no space in 3CA, 3CB given that the whole responsibility of management and liability of auditors, we cannot produce. But they have suggested that in clause 3 of 3CA and clause 5 of 3CB, we should insert the responsibility statement both from the management as well as from the auditors, and which is exactly given in SS 700. In our guidance note itself, on the same page number 65 or something, the exact illustration is given and what to write it should be given. I am very much happy that the institute is providing us all the foods for us. Only thing we need to go through it and follow it. So according to me, this is required to be given in form 3CA and 3CB. Now the question arises whether where is the space and how it has to be inserted. Several people have, several offices have different practices for that. After 2022, it becomes rather, according to me, it has become mandatory, and for our safety side, which all the auditor to save our skin, we should insert it. If not, we should immediately follow it. Some of the firms, they are having this complete detail in that particular format and clause 3 and clause 5 of 3CB only. Some of the offices, they mention the annexure attached to that in the column from the clause 3 of 3CA and clause 5 of 3CB. And along with the 3CA, 3CB, this annexure is attached. And that is how the compliance is there. However, so far as the audit is being carried out under any other law and this audited balance sheet is available, that in that case 3CA, we are not going to certify true and fair view, so we don't have to write there only. But so far as tax audit is concerned, we are supposed to maintain this decorum and mention the reference about SS 700 with verbatim which the institute has given to us. That will save the country. So according to me, now it is beneficial and rather mandatory for all of us to insert this SS 700 phrase through our 3 paragraphs are given in the guidance note itself, and we should make it possible that it should be mentioned there only. And in that case, we are the auditor of a partnership firm which is not audited under any law, then according to my personal view is that so far as true and fair view is concerned, we should mention. Previously, we were not giving audit report on non-corporate entity. Now the institute has also prescribed the audit report of non-corporate entity. So there we are having this SS 700, whatever is applicable. And for 3CD and 3CB and 3CD also, we should have this place. So in that case, if I am the auditor of firm, a partnership firm, I am carrying out this tax audit, then I am certifying the financial statement of partnership firm also, and I am certifying 3CB annexure also. That is, so at both the place it is very important to have this paragraph of SS 700. That is what I understand. And after 2022, I think it is our mandatory job to do it. Otherwise, sometimes something can happen, like NAFRA can come to anything lower down. Right now, it is for a smaller company, it is not possible, but there is not far that they can also view from this point of view also. Thank you.
Very rightly said, sir. Now when we talk about SS 700, the immediate question comes about the qualified opinion. Sir, for a non-corporate entities, even compliance with accounting standards is now mandatory based on the level of entity in which it falls. In many of the non-corporate entities, we normally observe that not all accounting standards are completely followed. Like AS 10 or AS 15 or AS 22, they are not very rightly or followed in the correct spirit. So in that case, still many of the tax audit reports go without any qualification. So does a tax auditor have a responsibility to report about the same?
Yes, as far as this guidance note for non-corporate entity audit, level 1, level 2, level 3, level 4 is given by institute. Level 1 applicable, all accounting standards are applicable to level 1. Level 2, 3 and 4, there are certain exceptions. Accounting standards just like AS 15 is applicable, but reporting is limited. AS 10, AS 15, AS 22, all accounting standards are applicable. So in my view, we should mention in this report whether it is a qualification or it is a disclosure or it is a disclaimer, whatever way we want to, we should have a professional judgment to that extent, and we should mention that this the firm entity has not followed this. Says, for example, is AS 15 in almost more than 80% of the cases, AS 15 is applicable and they are not following. But when you are certifying and when you are giving a reference of SS 700, then rightly this moderator is right enough to mention that it may be 700 or 705 or key management, whatever you believe, but it should be, disclaimer should be there or reporting should be there.
And just to sum up the qualification part, a very common observation that we normally see is that in non-corporate assessees, there are large number of balances of debtors and creditors which are outstanding since long, or they have a negative balances. In that case, is there any responsibility for the tax auditor to comment on the correctness or confirmations of the same, or the tax auditor can rely on the management's decision?
See, again, it's a basic of audit profession that since day one, this right from the insertion of tax audit or even a financial statement certification, we have been groomed that debtors and creditors, we have to analyze, we have to give in the age. Now it is mandatory in case of companies or non-corporate entity, but previously it was not there. We used to write that balance of sundry debtors, creditors, loans, advances are subject to confirmation. Now Institute has categorically said that it is the responsibility of the auditor that you should make an attempt, reasonable attempt to have the correct information. Simply blindly we cannot write this thing. And all these debtors and creditors, as an auditor, I would like to see that if there is a debit balance, I would really advise to the entity that it should be written off if it is not recoverable, so that it adds to the benefit that even bad debt claim is available in tax computation. And if it is a credit balance long outstanding, it should be written back, whether it is 41, section 41 is applicable or whatever it is, but it should be written back if he really thinks that it is not going to be. And particularly such balances are in case of capital balances which is to be written off, that is written back rather, then one has to take a care that whether it is a revenue in the 41 or it is to be deducted from the cost of the asset, that has to be ascertained.
Yes, sir. Another ignored aspect which I consider is compliance with ICDS and accounting standards, and I would like to go to Jignesh Bhai for the same. Jignesh Bhai, as we discussed for accounting standard 15, as we discussed, it is a very common non-compliance that we observe. Can you discuss on the applicability as well as on the level of entities that it is concerned? How do we practically apply accounting standard 15?
Thank you.
Mike.
Am I audible? Hello. Yeah. AS 15, as Mukesh also pointed out, is one of the most ignored accounting standard as far as mainly non-corporate entities are concerned. In fact, I would say, as he rightly mentioned and Manthan also mentioned, AS 10 and AS 22. AS 10, we all believe that the depreciation is provided and therefore where is a non-compliance? But standard also requires certain disclosure part. Now AS 10 gross value of the common non-compliance that I see is first is the exemptions. It is not that it is not at all applicable. It is applicable with certain exemptions. For example, for leave encashment, they are not supposed to make provision for leaves which cannot be encashed, or leaves which are encashable or which can be enjoyed beyond a period of 12 months. Or they are not required to do the present value or discounting. But as far as the gratuity part is concerned, they are required to make a provision for gratuity if payment of gratuity act is applicable to the entity. Meaning where the number of employees are above the threshold under the payment of gratuity act, which is I think 10 as of now.
10 employees.
So if there are more than 10 employees, gratuity provision is required. No doubt this smaller entities or level 2, 3, 4 entities, if they have less than 50 employees, level 2 and 3, if they have less than 50 employees, they are not required to calculate or the value of gratuity based on PUCM method or the actual valuation. They can have some logical or rational method to make a provision, but at least they have to make a provision. If the provision and practical experiences, nobody makes the provision. It is only when they pay, they debit the expenditure. And income tax department is also not bothered, because even if you debit the expenditure under 43B, it is going to be disallowed. So, if you don't debit an expenditure, income tax people are last one to bother about it. So they also don't ask you on that. But technically, with now tax audit quality review board in place, it is necessary that we give a good quality of the tax audit report. And if at all the SSC has not made the provision, we make a disclosure in the form 3CB, or of course in case of corporate entity, your audit report under Companies Act would cover that. But in non-corporate, you have to make a qualification in form 3CB. Again, there are, one should look at the standards applicable to level 2, 3 and 4 entities, and wherever the standards are applicable, not only the accounting treatment, but even the disclosure requirement are required to be fulfilled. And we miss on that, because non-corporate entities do not make a disclosure compliance. So we need to even follow that.
Another aspect that is also ignored is in case of a service industry. I mean, normally in case of a trader, we always have a closing stock. But what we miss out is in case of service industry also, there are chances there is some inventory on hand. And normally it is not shown as a WIP in the books. And ICDS 4 on revenue recognition mandates the SSE to make such a provision. So can you highlight on that aspect as well?
Yes, service industry, the first thing one should keep in mind is ICDS are applicable only to the people who are following mercantile system. Those who are on cash basis of accounting, ICDS are not applicable. But not that means that you do not make a provision for inventory. But if we look at the ICDS, for service sector, the revenue recognition ICDS says that it has to be on a percentage completion basis. Subject to that where the service period is less than 90 days, you don't need to make a provision for WIP. Say for example, a hospital may have an accounting policy that we only bill the patient upon discharge. And normally the period of stay is never 90 days in case of an hospital. And if at all, if it is beyond 90 days, interim bills must have been prepared. But let us take a construction contractor. The contract may go on for 2 years. And in that case, typically he has to follow a percentage completion method. Not only that, inventory is required to be provided, or whatever inventory is supposed to reflect it as inventory. The problem arises in this kind of cases where they buy the inventory for utilization in service. If you look at ICDS 2, it specifically mentions that materials and supplies used in provision of services are also inventory. Now, take a case of a construction contractor. Whatever, he may be using some scaffolding or the construction equipment or whatever, which are, so to say, not having that long life. But it is not a one-time use also. It has a use which can be used for 4, 5, 10 projects. So that inventory is required to be provided in the books, and he should debit the inventory or reflect the inventory in his books. Normal practice is whatever they purchase, they debit to expense account and just expense it out just to lower that profit. I think as an auditor, we should object to that. And one of the better way of convincing the client or telling him is to work out your monthly purchase sales. Or for example, let's take a case that a contractor in the month of March has billed only 50 lakhs. So his revenue is only 50 lakhs. And he has purchased some materials for 100 lakhs in month of March. Now, it's a clear case that there is definitely some inventory. How for a 50 lakh revenue you have spent 100 lakhs? That cannot be the case. So in that case at least, so the better course is you work out the monthly sales purchase figure, and wherever you can even apply GP rate and find a negative stock in between. So if there is a purchase in the subsequent months, it will immediately catch your attention. But the bottom line is these clients do not maintain the inventory record. That is the most practical difficulty that we face. And I think in that case, it is better to put a qualification in auditor's report that inventory records are not maintained, and we have relied on the inventory prepared by the SSE, or maybe inventory physically taken by the SSE, and that's the kind of disclaimer that one can, or a qualification that one can put. But I do agree that yes, this normally in this kind of cases, people don't put any inventory, or they put a minimal inventory. And when you put an argument, they say, we follow the same practice since years, so even opening stock is like that. But that cannot be an excuse or an answer to a wrong accounting practice that they are following.
The last is relating to share market. Normally in last many years, we have seen people actively engaging in share market transactions, probably after COVID. In case of a derivative transaction, what normally the practice has been followed is broker nu ledger laine undi entries kari nakhya. So in that case, it is not always possible, like we discussed for inventory, same way for a share trader, it is not possible that all positions on 31st March have been closed out. When we mirror the broker's ledger in our books of accounts, we unintended consequences, we report the open position profit and loss as well as a current year profit loss. So how do we identify the open position profit and loss, and based on the guidance note as applicable, how do we account for the same? And its impact in the tax audit report, yes.
Yeah, so I think there is a clear anomaly between the guidance note of the institute and the ICDS. Because guidance note tells you that, even a notional gain or loss on unexpired contracts is required to be provided. Basically, guidance note says that any derivative contract is to be accounted at a fair value. So fair value is whatever is the value as at the year end, that is 31st March. So if at all there is a profit, you account for profit. If there is a loss, you account for loss. Now ICDS technically says that mark-to-market losses are not allowable. Meaning thereby, if you have a derivative contract which is live, which has not expired on 31st of March, and if there is a loss in that contract which you have provided, ICDS says that such mark-to-market losses are to be ignored. Now, typically ICDS says only on the loss side. Obviously, it doesn't say on the profit side. Now, if somebody follows a guidance note of the institute, obviously you would have accounted for profit as well as losses. And based on ICDS, losses are to be added. One can definitely reduce the income based on a real income theory, because this is not it's a notional income. It is not a real income. But again, then you will have to go and explain when you reduce that. So either way, if you follow guidance note, you are not following ICDS. If you follow ICDS, you are not following guidance note. In my view, whatever you do, ultimately these losses are to be ignored. And if the SSE has followed the guidance note, in the ICDS part of Form 3CD, we have to give a disclosure that there is a non-compliance to ICDS to that extent. Mark-to-market losses of so-and-so value are debited to statement of profit loss, and that is required to be adjusted in the statement of total income.
Correct, sir. Now I quickly go to Palak, sir, with certain aspects of disallowances. Sir, with the dividend getting taxable in the last 2 years, one ignored aspect is Section 14A disallowance, which was normally linked with the dividend because it was more or less exempt. Now, after dividend becoming taxable, does 14A have a role to play? Because I am sure there are still many other exempt incomes like share of profit from firm, or there is an interest on PPF. So in that case, whether we need to apply 14A, because I am sure in most of the cases 14A is ignored. And another aspect too is it, in the pre-dividend, I mean when the dividend was exempt, the prime argument for the SSE was that the SSE had interest-free funds and therefore no disallowance was required under 14A. But now Rule 8D prescribes a specific formula that it is to be disallowed based on 1% of the average of the monthly investment. So in that case now, whether we are required to disallow under 14A if we have exempt income or not.
Good evening, seniors and members. It is clause 21H of Form 3CD, which requires us to report on section 14A. I would here acknowledge that the very first seminar which I took for the members in 2002, I suppose, was on 14A. So I'm thankful to Manthan Bhai for giving me the reminder, and at that time the dividend was made exempt. As now the dividend has been made taxable from the financial year 1920, it has got less implication. But as you have rightly pointed out, sir, as profit sharing from the firm is exempt, or interest on PPF, or maybe you have the agricultural income in your ITR, whether you are supposed to report or not. I would divide the same into two. Number one, it would be the tax auditor who has to rely on the management representation in writing that this much need to be disallowed. It is as per SA 580, wherein this disallowance is required. If, say for example, management is not ready to give the representation, then it would be the auditor who has to make a fair estimate as per SA 540 that this should be the disallowance. Now, these are all the things which I am speaking from the guidance note. Talking about the practicality from this August gathering, I would be honest, and I hope I am not going any step ahead in saying that there are very less members who are making the report of this clause 21H, if not reported, because there are going to be own fund as well as there are going to be borrowed fund. Whether we need to report, number one. Number two, after amendment made in the year 2022, Budget 2000 Finance Act 2022 about this section 14A, that even if there is no exempt income in the current year, but if the investment is made in the earlier year, then also section 14A would be applicable. Would it impact the auditor? See, practically speaking, we are taking the shelter of certain decided case laws. Number one, if we are able to prove that there are sufficient own fund and that is invested in agricultural operations or that is invested in the partnership firm, then apparently there is no question of disallowance said by Honorable Ahmedabad ITAT 2015. It is Gujarat Narbada Fertilizer Company Limited. So that can come to our rescue if at all it is not reported. Same way, if we have partnership, coming to Manthan Bhai's direct question, if there is fund borrowed on which we are paying the interest and invested in the partnership firm, then this partnership firm is giving us tax-free profit sharing, but taxable interest and taxable remuneration. At least we can connect with that interest which is taxable under section 28, and we can have appropriate appropriation, as I have said earlier. So, summarizing, it is advisable to get a management representation report. If not, get an estimate, and if not reported, we can take the shelter of various judgments in the favor of the assessee. But that favor of the assessee and judgment is definitely going to be our back thought.
Yes, sir. So last year, if we all remember, SEBI had come out with a SEBI settlement scheme, and many of the people had took the benefit of paying the compounding fees. Not only SEBI settlement, but even in ROC, many of the companies are paying compounding fees to correct the errors that they must have committed in the past. Or the company must be filing late ROC returns, and in that case, additional fees are payable. Sir, whether all these sums are required to be disallowed under section 37(1) as in connection with a penalty, or whether these compounding fees are not required to be disallowed.
Manthan bhai, let us first talk about this SEBI settlement scheme, which was, I think, last year,
Last year.
during the COVID period, wherein if certain irregular transactions are done by the investor, then there were notices issued. I think they were to cover the investor under section 15H
Correct.
A or HAA of the SEBI, and they were, I mean, there was a minimum penalty, I'm using the word prescribed, worth 5 lakh, minimum 5 lakh. Then they've come out with a settlement scheme and said that you pay one registration fees and then settlement fees, and then you are going out clean. In my humble opinion, this SEBI settlement registration fees as well as SEBI settlement fees both are allowable and need not be reported in clause 21 of form 3CD. I would rely for the same on a slightly old circular 772 dated 23rd of December 1998, not exactly on this, but the circular says, along with Honorable Mumbai ITAT judgment in the case of Anil Dhirubhai Ambani, that when there is fees you are paying for the settlement, you are not proved guilty. It's been an exit you are taking, and hence the nature of the amount which you are paying to SEBI is not penal in nature. It is not an offense which is proved, or it is not, I would say, legally you are proved wrong. So, according to me, obviously the safe side for the auditor would be a different thing, legally speaking, that it should not be. Coming to the compounding fees for ROC or any other law, if it is criminal in nature, because the verbatim of section 37(1) for the year for which we are auditing at present is any offense or which is prohibited by law need to be disallowed. So if it is compensatory in nature, it need not be reported, it is not going to be disallowed. But if it is penal in nature,
Yes.
the reporting is required, whether it is company law or whether it is any other law.
So just a follow-up question. If the SSC has already disallowed this sum in the ITR, then whether we are supposed to report in the 3CD or not, because there have been issues when 143(1) notices were issued for the same.
Right. Generally, what happens is the reverse case, that we disallow something in our tax audit report and SSC goes to someone else to get the return filed, and the tax return preparer is not disallowing the same, 143(1)A is going to come. But if your SSC is ready to offer this to tax and disallow the same, then according to me, we should play very safe in reporting the same in clause 21, whether it is SEBI settlement or whether it is compensatory or whether it is whatnot. We should advise the client it is allowable, but if he says that no, I want to disallow, then it would definitely be reported.
Yes. Think of the phrase used and consider it as ITC under GST and report the sum in the said clause.
Yes, this SANVET word is used in Form 3CD. Then I would say that it was relating to excise law and then service tax law. By introducing GST, there is no word in GST like SANVET. And popularly everybody is voluntarily replacing that and putting all the reporting so far as ITC is concerned. But we should remember that even SANVET still has a life. This SANVET is applicable where GST is not applicable. Like in a liquor business or petroleum product, there is still excise, it is not GST. So if I construe the legal words of SANVET, then I would say that SANVET is still there, and if my entity, my SSC is not in that business, it is, I don't have to write. But looking to the other form, what Manthan has said that in e-portal and everything, we also advise our client that forget about the name में क्या रखा है, वो you provide the information of ITC, and merrily department is also accepting everything, but strictly reading to the form and law, Sanvet is still has a life, particularly petroleum and liquor product. So if to be more specific about this, if Sanvet is, nothing is reported under Sanvet clause, we have a good case to fight out that my SSC does not fall in the Sanvet, and that provision making information, giving information of ITC, and it is an additional thing, or say for our sake of safety we are doing, or with a ultimate motive of institute to help government to make assessment, and so to have the information with the department regarding ITC. That is what my understanding is.
So just two small follow-up questions. One, in case the SSC decides to report, whether that reporting should be based on the electronic credit ledger or whether it should be on the books of account in case they do not tally.
I would say that the fundamentally from 3CA and 3CB, what I am certifying is books of account. I am advised by law, advised by the institute that it should have verify the relevant documents, books of accounts and everything else. So speaking for myself, I would really go with books of accounts because that is my prime responsibility. I cannot alter any figure other than books of account. However, if that is not tallied with electronic ledger, I can give a disclosure that this books of accounts is not matching with the electronic ledger, and SSE is given this reconciliation, that is okay. But so far as I am giving my true and correct view, I would prefer to go with books of accounts only, and that is more, I think that it is my duty to give true and correct view on books of accounts. Subject to other things, additionally I can give this difference, I can give the reconciliation and everything. I am not putting my adventuring into other, say GST or excise duty, say that as per this EL is the balance and this balance, and I won't change my true and fair view because of that. Only thing I may disclose it, or reconciliation, however, I will put a reconciliation only.
And lastly, sir, as we discussed, in case there is a difference between the books GST data and the data that is filed on the portal, as a tax auditor, are we required to report on the differences in case we are not the GST auditor and we are unable to reconcile these balances? Because normally, sir, what we face is all this reconciliation is done after the tax audit report is filed because GST return due date is later on. So in that case, as a tax auditor, are we supposed to dig into this aspect?
Speaking for myself, I would say no. As I have said that I am concerned with my books of accounts. I am concerned with the correctness of the figures from my books of accounts, and I am not at all concerned with the GST or any other law rather. You see, in that case, if you extend this logic, if GST is there, so there are certain law for which this litigation is going on, like SEBI or labor law, so which we do not know. I do not have any jurisdiction to enter into another law. I would certify my books of accounts. Let GST auditor do his job at whenever it is. We may have difference of opinion. There are number of changes from 9C at the end of the year. We change everything. But when I am certifying true and correct figure, I will stick to my books of accounts only. In case I am the auditor for or my firm is the auditor for this GST also, then I think that morally we should do it and try to reconcile it and make a necessary disclosure. If my firm is the same as the auditor in GST as well as tax auditor, I would take that responsibility that yes, sooner or later I have to do it, now let me do it. And if there is changing also, it is explainable at the time of filing, there's a 9C report or whatever it is.
Coming back to Jignesh bhai. Sir, in case of small SSEs, normally what we observe is when the inventory records are not maintained, what the SSEs normally do is identify the GP ratio based on the past experiences, and then at the end of the year, they determine the closing stock based on the GP percentage. So in that circumstances, as an auditor, what care should we take while reporting in 3CD form?
I think,
And also how to report in the quantitative details clause.
right. I think this is a question which has a very wide implication, and this is a common practice that is being followed by all traders and the small businessmen, that they decide the tax payable first and then the profit and then the inventory. So they work out the reverse way. And forget, you put a question little bit in a nicer way that based on GP, but it is based on tax payable, I would say. But, even if it is based on GP, how as an auditor do you certify that the inventory is correct? Now, but our duty doesn't end there. Institute also says so. I think by qualifying, but at least in the interest of the SSE also, we can do a backward testing, as I earlier said, that monthly purchase sale and GP you apply and find out, because many a times if you start debiting expenditure or the purchases at year end, it will show a negative inventory in between. So, but in any case, if the inventory records are not maintained, I think qualification is a must.
Yes. So in case of a service industry, whether we are required to report the ratios, or can you highlight what are the common errors that normally takes place in our offices while we report the ratios in 3CD form?
I think the ratios, as far as the service industry is concerned, the institute's guidance note also says that there are 5 limbs of the ratio. First is the turnover, second is the GP, third is NP. So institute says that in case of a trader, in case of a service sector, item number 1 and 3 are only applicable. That is the net, you have to report the turnover and you just have to report the NP ratio. Again, the recent publication of the Tax Audit Quality Review Board has, in one of the observation, the most common error in ratio is the miscalculation of the net profit ratio. The institute's view in guidance note is also that the net profit ratio is to be calculated for the profit before tax and not profit after tax. So this is one common error that normally we face or we see. Second, the common error is in the stock in trade to material consumed ratio. There in stock in trade you need to consider only the finished goods stock and not the other stocks. So normally people consider entire inventory into that. So even that ratio is, or even stock turnover ratio also.
Yeah.
So those ratios are, in guidance and also all the definitions are given and how to be calculated, that is mentioned, so one can look into that.
Okay. Palak sir, a very old clause 269 SS, but still there are many errors that we do in reporting. So one of them is whether we are required to report the loans including the interest and the tax deducted thereon while we do the debit credit, because normally what we see is when the articles prepare the tax audit report, they open the ledger, total credit is loan taken, total debit is loan repaid. So in that case, whether interest is to be taken into consideration or not, and secondly, if the interest remains unpaid, then whether it can be considered as a loan or not.
Answering the question from the viewpoint of the article. What they do is, Manthan bhai, as you have rightly pointed out, total of credit, total of debit. Total of credit is accepted, total of debit is repaid. SS and 269T. What we do in the practicality as a member is, we ignore the interest. We don't calculate the same in the loan acceptance. We don't calculate interest repaid also in the repayment. If we ask the article that why you have included, actually has included because Manthan bhai has rightly pointed out, it is total credit and total debit. Then he'll take you to the section proper. Section 269 double S and 269T, I would say, not double S, talks about any repayment of loan. There the verbatim of the legislature are together with interest. So there it may create a problem, but practically speaking, neither it should be included in acceptance nor it should be included in the repayment, including, I would say, the TDS, if at all we have made on the same.
Yes. Okay, so last 5 to 7 minutes, let's just do a rapid fire round. Sir, I'll be asking questions to each one of you very quickly, and I'll request each of you to be brief in your answers as well. Some important aspects. Mukesh sir, I'll start with you. So in case there is a change in the inventory costing method from FIFO to weighted average, whether it is required to be reported or not?
It is not a change in method of accounting. What 3CD and what tax audit or what section says that if there is a change in method of accounting, you should report and report with the effect of on profit and loss if any. So changing the method of valuation of stock is not a change in method of accounting. It is a change in accounting policy. I would really add to it that in AS1 only you have to report that there is a change in method of valuation of stock. Apart from that, ICDS 1 also says that if there is a change in method of valuation of stock, you should make a mention of it, and if the effect of the same is material, then you have to quantify it. But that, according to me, that does not make it, is not a change in method of accounting.
Okay. Jignesh bhai, normally when we report the books maintained and books of account examined, what is normally observed is we write the books of accounts. So is there anything else that is to be reported in that clause?
I think the 3CD form says books of account maintained and books and other documents examined. So the guidance note also said documents means the documents on the basis of which books are prepared. So all your purchase invoices, sales invoices, vouchers, bank statements, maybe some important contracts or deeds, whatever on the basis of which books are prepared, that needs to be mentioned there.
Palak sir, is it mandatory to upload signed financials along with the tax audit report, or whether we can use digitally signed documents, or whether SD also works?
As per our guidance note of ICAI, it's para number 16.3 and 16.4, they permit digitally signed or physically signed. They have specified that if it is hand, hard copy, physically signed, soft copy can be digitally signed, but they are silent on SD. So I am afraid SD won't work. Otherwise, digital, physical, both would.
Mukesh sir, whether revision of 3CD for reason other than 43B is valid or not? I mean, the portal allows us to revise, but whether it is legally valid or not?
Yes, for the purpose of 43B it is allowed. Even CBDT has also clarified the same, but the payment must be made before due date of filing the return, and then you can allow. But as far as my understanding goes, other than that, when there is a change in revision of account by the company, say company revise their accounts after completion of audit for some reason or other reason, then auditor is entitled to revise the 3CD also. The other thing incident is there is a change in law, substantial law with retrospective effect, then also it should be allowed to be revised the things. And then change in interpretation by CBDT circular or something, that which has after our signing of 3CD, there is a circular or something, then we should be allowed to change it. These are all 3-4 instances where the auditor auditor should revise the 3CD report to be in line with the object of the government and institute to help the department to make the correct computation of income.
Correct. Jignesh bhai, normally what we observe is in case while we are auditing, we identify there are certain expenses on which the assessors fail to deduct tax at source. And during the course of the audit, we ask the SSC to deduct tax and revise the return. But while we are filing the tax audit report, till that time, the SSC might have paid the tax, but he has still not revised the TDS returns. In that case, as an auditor, are we required to report on this aspect?
I think yes. I think clause 34B says that where taxes or where the return filed by the SSC covers all the transactions on which tax was
Required.
deductible or not. So this is a transaction on which tax was deductible, SSC acknowledges the same, and he has already paid the tax or passed the entry in the books at least. And still he has not revised his TDS return. I think we have to report in form 34B, clause 34B. I think even people are missing something even in clause 34C also. Clause 34C talks about interest payable. And in my view, if there are defaults, popping up on the Tracy's portal pertaining to at least this financial year, against which SSC has not filed any rectification or has not initiated any action, even I think I would be tempted to report that also, because technically it is an interest appearing on portal and SSC has not done anything about it. So even at 34C also, I would report those things.
Lastly, Palak sir, normally what happens is when the SSC has an addition to the fixed asset, we are required to report the date of purchase and the date of put to use. I am sure in most of our 3CDs, both the dates are the same. So as an auditor, whether we need to exercise our judgment about the date of put to use?
I would say that if it would have been in July, yes. But in this power play, even if I say that yes, we have to, it's not possible for even my office to exercise or anyone's office to exercise that. But yeah, academically answering, put to use is now the concept wherein you are going to get the depreciation. So it's advisable to check out with the delivery challan. It's advisable to check out with, say, your asset is used with the, usage with electricity, increase in the electricity bill or new labor employment or production has increased or not. So that academically speaking is required. But on 9th of September, when there are no chances of extension, if I am not mistaken, sir, then in that particular case, date of purchase is the date of put to use.
Thank you, sir. With this, though I tried to cover almost all the aspects, certain questions were still left out due to paucity of time. But nevertheless, I am sure most of you must have gained something fruitful from this session. And what I gather in a summary is, our 3CB or 3CD report is our mouthpiece. And I would request everyone to put all the disclosures and disclaimers that they think appropriate in the 3CB rather than copying and pasting from the previous year. I would like to thank the esteemed panel for their time and for deliberating on this topic, and as well as I would like to thank all of you for sparing your time on this Saturday evening. Thank you so much.